Vanguard has made some predictions, and they don't think the next decade is going to be as good as the previous one. And this report, it's packed with a lot of jargon and kind of hard to understand words. So I'm going to break it down and communicate it simply for you. So by the end, you'll understand what are the key points and then how to apply the knowledge to your own financial picture. And then also, I want to tell you what I think we should do as we're moving into this next decade and thinking about retirement and thinking about our own financial picture. I'm Dave Zoller, certified financial planner and owner of Streamline Financial. It's a retirement planning firm in Illinois that helps people around the country. So let's get into the first point, which is Vanguard thinks that bonds are back. Bond investors have had a tough time with interest rates close to zero for quite a while, but Vanguard expects U.S. bonds to return nominal annualized 4.8 to 5.8% over the next decade, much higher than what they thought or what they expected before the rate hike cycle began. And similarly for international bonds, they expect annualized returns 4.7 to 5.7 over the next decade. And because of this, the 60-40 portfolio we hear so much about has strengthened according to them. So their probability of achieving 10-year annualized returns of at least 7% has increased. So good news for the 60-40 portfolio, according to them. Just something to keep in mind as we're thinking about what the right mix is of stocks to bonds. The next main point is they're thinking higher interest rates are here to stay. So let me read what they said here. Even after policy rates recede from cyclical peaks in the decade ahead, rates will settle at higher level than we've grown accustomed to. That's their thought. Translation is they think we're not going back to the days of cheap money where you could get a mortgage for 2 to 3% interest rate. They think rates are going to stay and maybe go higher or at least stay high. And here's a history of rate cuts and what they think or what they're forecasting for 2024. But it's already June and this hasn't happened yet. Just the other day, the Fed leaves rates unchanged. This is as of the 12th of June, despite inflation progress. So that's most recent news. But this could also have some positives, right? Here's back to the original outlook. So they're talking about higher interest rates, but this could be borrowing and saving behaviors can reset and capital allocated more judiciously. But how I would translate this paragraph is that people will invest and spend their money differently from the last decade, right? The last 14, 15 years made it hard to keep money in the bank, right? With interest rates so low, earning a 0.1 or definitely less than 1% on safe monies. Now we're getting 4 to 5%. Makes it a little bit easier. But the thing to watch out here for is we really want to be wary of, yes, interest rate 5%. Wow, we haven't seen that in a while. But where's inflation? Let me pull up this on the next slide. Here's the Fed funds rate, this line, and then CPI. And again, this is their calculations, but this is kind of a picture of what is, things are getting more expensive. We're getting an interest rate return on quote, safe monies, but things are also getting more expensive. A lot of times when I'm going to the grocery store, it seems like it's even increased more than this over the last few years. But now let's take a look at the stock market outlook according to Vanguard. They've categorized different parts of the stock market here on this side and then shared what they think are things undervalued, fair, or overvalued. And the white circles are what they thought a year ago, and then the colored circles are what they think now. And the big picture from this is they think that stock market valuations are too high, particularly U.S. stocks. Where they do see potential undervaluation or possible opportunity is emerging markets and small cap. So here's small cap and emerging markets. And these colors on here I added as overvalued red and then fair valued yellow and then green might be undervalued according to Vanguard. And coincidentally, those two, small cap and emerging markets, often when we're doing a portfolio review for somebody who's not a client, we see that that's the least amount, or they're often under allocated to those two things in their current allocation. But back to this, just to give a quick overview, U.S. equities, they think is the most overvalued thing. And then as they break down some of the large growth, large cap and value, they're looking at growth funds kind of being most overvalued. Down here in terms of the different types of fixed income, sometimes just called the conservative or bond bucket. They're seeing high yield as one of the overvalued. That's another thing we sometimes see. This is anecdotal here, but we often see people stretching or reaching for these high yield bonds or credit and trying to get a return. But often those things are acting like stock funds. So part of that whole thinking of conservative or growth or 60-40 mix, again, high level view, a lot of times in the conservative bucket, people are taking on more risk than they think. And during a time like 2022, it's a surprise, which we don't want to have in a retirement allocation. At least that's my opinion. That's how our clients think about it as well. So what do we do about these predictions from Vanguard or from other economists or people trying to look out the next few years or 10 years? Should we be doing anything different? I've been reading these from Vanguard and other economists out there for the last 15 years. And what I've realized is Vanguard and other economists, they make these predictions, but you want to know something interesting? They don't know what's going to happen. And they haven't always been right. They've actually been wrong. And I've got proof because I went back in time and I looked at the same report, but 10 years ago, where they were predicting the next decade to today. So this is from their 2014 outlook for the next decade ahead. So this is from 2014 to today, which is 2024. And we can see here, simulations for 10 years return centered 5 to 8% range. It's going to be below historical averages. And this is even lower than the previous year when they were doing it this time last year. And then they give reasons. Outlook, it can be attributed to the fact that current market valuations have increased as markets continue to price in structurally lower growth world. And here's the big one, 50% likelihood that global equity portfolio will fail to produce a 5% average real return over the decade 2014 to 2024. So there's the last decade, which turned out not to be true. What actually happened was total stock market was closer to 12% per year averaged out, but that's much better than anyone would have expected. So why am I even making this video? Thinking about what Vanguard thinks or predictions of what economists think. This is a reminder to continue to look and see and hear the predictions. They're gonna keep coming at us, and we could watch and pay attention. But what should we do with our money, right? We'll hear it from CNBC. We'll hear it from our neighbor who tells us about all the great gains and big winners that he's had over the last year, but he never talks about the losers. So this is just a reminder to create your plan, not based on predictions or what you think is going to happen, but base it on what you need, what you want, and then also the weighty evidence of history, just to help guide in making wise decisions with your money. So create that plan, look at the what if scenarios. That helps a lot and brings a lot of peace of mind. Those are the things, what if this happened? What if interest rate was higher? What if it was lower? What if returns were 5%? What if they were more? Look at all those things ahead of time so they're not questions in your mind. That firms up your belief and your confidence in the future, and then you can live that life that you're really looking forward to in retirement. Both the good scenario or the bad, if it happens, you'll be prepared. So I hope that was helpful. If it was, give this video a like or say something below. I'd love to hear from you, and then I'll see you in the next video. Take care.